when was the last time that the Fed and the Treasury and the FDIC held an emergency meeting on a Sunday, followed up by a speech from the president telling Americans, as you say, don't worry, everything's okay. Look, they've lost all credibility. First, they told us there was no inflation, and then that it was transitory, and then it became structural. Then it had peaked, but then it reemerged, and it's all crap. I think they're very scared, and the time to be scared is when they tell us not to worry. I think that is really the time to be scared, when they've got everything covered, when the taxpayers won't be burdened for this, when we know that that's really not the case. Yeah, they may not bail them out with taxpayer money, but they will pay for it with newly created money. They try and tell us that it's the money coming from the fees that the banks pay for the FDIC, which covers 0.03% of the deposits that are north of $9.5 trillion, backed up by $125 billion in assets. We talked at length about this over and over and over again. I have a bad habit of repeating things over and over and over again that are very important to me. So it's not a bad habit to me. It's just nailing home what's important. What did we talk about ad nauseum? The November meeting of the FDIC Systemic Resolution Advisory Committee. They told us this was going to happen. And let's talk about what really is happening before we talk about what they've done. And it's simple, but first an explanation of how it all works. And when you make a deposit at a bank, that deposit is not an asset of the bank, it's a liability. And so the bank needs to offset that liability with an asset. And that asset is usually a bond, a treasury bond or a mortgage-backed security bond. And during the pandemic, Biden removed or relinquished all of the reserve requirements that the banks had. So there's very, very little cash on hand to meet customer demands. And if there's even a small run on the bank, like we saw, the bank is forced to then sell bonds at a huge loss to meet customer demands to get their money back. And the reason those bonds are selling at a huge loss is that over the last decade, the bonds that have been accumulated by all of these banks, the treasuries and the mortgage-backed securities, probably average 2 to 2.5%. And with rates hovering at or near close to 5% right now, those bonds on their balance sheets have lost over half their value. So when they're forced to liquidate said bonds to meet demand for these withdrawals, it can render a large bank insolvent in less than 24 hours, like we saw last week. And you know what? The FDIC cannot handle this. Their insurance fund, as I mentioned, is 0.03% coverage of all bank deposits. So if one or two banks fail, it will drain it all. And so the only way to save the depositories was to monetize the banks, print more money to make them solvent and destroying the value of the currency. I guess they have to ask themselves, do we save the dollar or do we save the banks? And obviously they have spoken, rendering the dollar dead on arrival. But look, math is going to solve this problem at some point, and reality is going to solve this problem, and hyperinflation is going to solve this problem. And this is exactly what I've been saying, talking about this for the last few weeks. But the problem is too much debt, and all of this debt has to be repaid one way or the other, either by the buyer or the lender. And, you know, I guess they're going to try and pay off this debt done again by inflation. They have signaled that is going to be their choice, that quantitative tightening be damned. It's time to open up the floodgates, because there is no way. Look, in 2008, when they should have let the forest fire cleanse the forest, the underbrush, instead they papered it over. And the Fed's balance sheet went from 800 billion to 9 trillion. How are they going to, with a $9 trillion balance sheet, most of which is underwater because the Fed is loaded up with long duration, low interest rate assets against, you know, all of these obligations that are short term, whether it be the reverse repo market or the reserves, the excess reserves that the commercial banks are parking with them at 4 and 5%. They're underwater, highly underwater. How are they going to cover another $9 trillion in deposits? And that's, you know, assuming that some go bad. But the point of it is that they set a precedent here. And how can you bail out one bank and not bail out the next 2 or 3 or 4 that go under? And this is a bad deal. This is signaling, in my opinion, the beginnings of I don't want to be an alarmist and say hyperinflation, but this is signaling a massive wave of inflation. Well, the funny thing is, as they print more money to bail out the banks, it has to lead to higher interest rates to compensate for the inflation, which is only going to hurt the balance sheets of the banks more, and they'll have to bail out more banks by printing more money, which raises interest rates higher. It's a vicious circle. What they are doing is absolutely ludicrous, and it's embarrassing. And quite frankly, it's quite good for our business because they've signaled the end of austerity and more of the same continuing deluge of inflation.